Good morning. Today on the workshop, we're going to settle this debate. Does IV, implied volatility changes, affect dealer positioning? Let's get to it after the bell. Let me ask you a question.
It's been like a month since I heard that.
I know. You've been gone. You've been on vacation. Welcome back. And Mark's out today. So here we are. We haven't had the three of us in a while. But what's on your bucket list?
I see yours is beer.
This is the shirt. I'm not a big beer guy. I like beer, but it doesn't like me. What can I say?
I'm kind of mad on beer.
Yeah. I mean, I don't dislike it. I like the taste of it. I can only drink about one of them. Then I move to something more interesting. Anyhow, so welcome back. Were you on vacation?
Yeah. We went to Europe, went to Spain, Italy,
and in the middle of you crossed the border in Spain, right? You were one of those guys.
Crossed the border.
Did you hear about this? They swam.
Oh yeah, no, I wasn't in Morocco.
Oh, okay. Whatever.
Yeah, no, I did cross the border, but on a plane and legally.
Perfectly legally, right? Legal. Okay, good. Was it fun?
Yeah, it was great. We had we went to Madrid, Barcelona, and then we got a cruise, and in the middle of the cruise was that eclipse.
Oh, so that's awesome, man. Good for
you. It was pretty cool.
Yeah, good.
Yeah,
was it an adult trip or was it with kids?
No, we bring the kids with us, man. They contribute to the household, so we we can't just hoard all the good things.
Okay.
But they had their own time too. They went to their little kids club, and my kids are old enough that they can wander around the boat a little bit. So
perfect.
They had their own fun.
Good. All right, let's get to it. Good to hear. Welcome back. So you pitched this out to me earlier. Do IV changes affect dealer positioning?
Yeah.
I'm going to let you answer the first part of the question, meaning what do IV changes do relative to the deltas of options? Now, that's a Vana question, I think. Is that right?
Yep.
Okay.
Yeah. So, I mean, first of all, this topic came up this week or last week. I commented on somebody because there seems to be, especially in the retail world, there seems to be a perception that gamma is the only thing that dealers hedge, right? Gamma and delta.
Mm-hmm.
And, and that those are the only two Greeks that have any impact on dealer hedging. And so I had a discussion with somebody who was actually, one of these gamma platform sellers, which there are a bunch of them now, who insisted that gamma was the only one. And I said, no, that's not the case. And, the thing is that implied, like the premium Greeks, anything related to time and volatility, which affect the premium of the option, they have an impact too, because as you said, implied volatility, if implied volatility comes down, then those wings, of the option chain, those wings, those deltas also come down, right?
Mm-hmm.
So, if those if implied volatility comes down and then the deltas come down from that implied volatility drop, then obviously dealers have to hedge that.
Yeah, or adjust their hedges, right?
Yeah,
I think you're saying the same thing. Yeah, so that I think that's all true, right? I think what you said is mathematically accurate relative to what happens when implied volatility changes, especially on the wings. And it will affect the dealers, what the dealer's book looks like. Now, the only thing I'd say relative to these things nowadays versus when I did it, as an independent, let's say, is I had this little small book of things that I had, and I traded, personally traded. My firm traded a lot of things, but me personally, that I was responsible for, traded, let's say, 50 different products. Okay, uncorrelated, independent. So I had to keep, my Greeks in each one of those separately. It wasn't in a book that was dispersed. So yeah, those kind of things were they weighed heavily on your hedging and your response, right, back then. Now, the only thing I'd say nowadays, and you can tell me this better than I can maybe, is what happens to the big Susquehannas and Citadels of the world and Jane Streets, where their book is no longer an individual product and they're not necessarily hedging Google for Google's sake and Netflix for Netflix sake. They're looking at an amalgam of everything. And maybe they have it sectored out or something. And if the whole sector starts doing its thing, it might affect the grand book, and they might have to make some decisions based on Vana and Charm relative to the grand book. So I don't know if that makes any sense, what I just said, but what are your thoughts on the dispersion part of that at the market maker level nowadays?
So I think based on, what we've seen and researched, that correlated products, unless they're like almost exactly like SPY and SPX, correlated products tend to have only really a major impact when they are illiquid products, because then it's it's harder to hedge some like small time tech company, but it's related to something that like AMD would do. So maybe they'll take AMD and include that small tech company with it or something like that.
Yep.
But stuff like Netflix and stuff where, well, I don't know about Netflix, but like Nvidia or SPX or SPY, they're so liquid and so well priced that I think that they don't need correlated products, right?
Yeah, and I think my feeling is nowadays the market maker community is, I almost think they hedge much less individual trades than they did in the past.
Yes, that's true.
I think what they do is, and again, I'm making these times up. I think they amass positions on a global basis, and they look at their book at 10 a.m. and 2:30 p.m. Central Time, and make a couple of hedging decisions based on the book. They're probably saying, okay, we're getting long too much tech, or that kind of thing. Let's we're gonna lower the curves here, that kind of stuff, sort of things. So I think it's more of a global look at their book with this stuff, and I think they hedge specifically much less nowadays. Not totally different from when I was doing it. We were individual little entities and little ships in the night doing our thing. So the other important part of this, though, and this was really prevalent when I was on the floor, is that there were pits where all the open interest was held by a small few people, right? Or entities that were smaller. And therefore, their hedging decisions could be swayed by Vana and Charm and implied volatility, this and that, and inventory. But nowadays, what I'd love to know, and maybe this is something for you to think about with your product, is I'd love to know who and how many hold the other side. So if it's just, let's say Group 1 holds all the GME options and Citadel's not playing really, and Susquehanna's not a big presence there, that all of a sudden becomes interesting to me because that hedge may be different, right?
Yeah. Well, I think, yes, I think they're in like the liquid names, I think everybody's involved. Stuff like NDX has a structural monopoly.
Yep.
I think Susquehanna has a structural monopoly on NDX, right? So I think there are like some other market, like small timers, but I thought it was Susquehanna product. And then, or Susquehanna service. I do think that I agree with you, though, that hedging barely happens like on a global scale. Like you said, I think we'll look at deltas. If they go a little off kilter, then, we'll hedge somewhere. Which is why I don't think gamma is that big of a deal anymore, because as big of a deal, don't get me wrong, it's a big deal, but they could price that away. I spoke to a couple of people where they said, yes, gamma is our biggest risk, but we are able to price options in such a way that we barely ever have to hedge it, right?
Yep.
And because, like you said, it's a global look, a lot of times, they won't, because gamma hedging really is kind of admitting defeat, right? So, if right, like, I mispriced this option and now I have to protect myself. And so they price their options where, yes, they can get hit, and COVID and stuff like that, Trump tariffs, they get hit. But Gamma seems to be well handled within the pricing of the option nowadays. Would you agree?
Yeah, I think so. I think it's probably one of those things where, like you said, it's probably hedged away pretty well, and they choose it or not, depending on a bunch of parameters. They being the community, the market maker community. I think they probably have a more interesting look at Vega, and they probably have a little bit, and to some degree deltas, which Gamma affects, right? So, but that's easy to hedge. That's hey, we're long 100,000 deltas sold. Sell me some spoos, whatever.
Yeah.
I mean, I'm making that up, but it's an easy one to fix. You park your deltas right away with a decision. But Vega's a little different story because Vega trickles down to everything, and it goes out in time, and it comes in time, and it's not just 30 days, it's 40, it's 80, it's 90, it's 300. There's a whole mash of that. I think where Gamma might be interesting is in expiring options, where positions are gigantic or oversized for a particular, for a firm. That's where things can get kind of interesting. Can they do it in SPX? It's a big product. It's $1 trillion notional product. I don't know. I'm not sure. Are there walls there, call and put walls? Not sure. That one is a mystery to me. I'm going to get one of my little old-time market maker buddies who's still doing it on the show one of these times and ask him about this. He won't tell us because we can't talk about that. Everything's so cryptic, with the big firms now. They don't like to talk about this stuff. So they like to buy bids and sell off this tool, though. I know that.
Yeah, they would talk a little more than you'd think. I mean, at RMC, we picked up some nuggets from some fairly large firms. It was like, and I was kind of shocked that they were willing to talk to us about it.
Yeah, but that's good. Yeah. They're not. Yeah, they're generally pretty. They're not going to give away the secret sauce, but
right.
Some generalities. Cool. So where did the debate end with this person? You just said we're gonna,
Oh, they blocked me.
They blocked me.
I mean, the thing is that you can never really. You could count on one hand how many arguments were settled over social media. Yeah. But it's just one of those, like, the data says something that, Vega changes have a lot, they're much less fungible and a lot more difficult to hedge than Gamma. And Gamma can almost be subsumed nowadays into the pricing or into the overall book. Yeah. So that's kind of why I'm like, Gamma, and like you said, and this is true even in our data, Gamma does have an impact on expiring options, but it wouldn't cause a crash or anything like that. That's the other.
I agree with that. I don't think that's the case anymore at all. Yeah. Now, the only thing I'd say, which was interesting, was back in the GME days, the GameStop, and even the car, what was it, Hertz or one of those?
Hertz, and then there was there was the movie theater, AMC.
Yeah, so those are interesting because they may not have good dispersion kind of contribution to the book, and they may be traded in a little bit of an outlier book in a market making firm, whereas a couple guys are managing it and watching it, and they're managing it within the product. Those kind of less liquid CD names can have outsized Gamma, squeezes and Vana and Charm issues that can play some big effect, in the movement of those stocks. We saw it in GME. It just was a snowball of all those things, kind of converging at once.
GME, I think, was hard to borrow, wasn't it?
It was hard to borrow. We had a big hedge fund that had to cover. So that put upward pressure. Market makers are selling calls out their wazoo, so they're buying stock. That put pressure on it. Because it wasn't something they could kind of throw in the book and say, oh, GME, that works against Chrysler. Why not? That works against, Chrysler, listen to me, how old I am. That works against Netflix. It doesn't, necessarily. Anyhow. Okay, good. We're saying it has an effect. We're not sure to what degree based on how the composition of a market maker's book looks. Yeah.
Well, I think it's more about how the book looks is to what determines the degree. But that's why at Volland we focus a lot on Vanna and Charm and stuff like that, because that is the less fungible hedging methodology. I'm not saying Gamma has no effect. It does, absolutely. But especially on like longer term options and it's almost just priced away, right?
Yeah, sure.
Yeah, or like you said before, correlative underlyings can help on that too.
Sure.
But so Wiz of Ops. That's my I'm the Wizard of Ops on X. So if you guys anybody out there wants to follow me and see me get blocked by people, come on over.
Yeah, and be surly. I highly recommend you follow Jason. Okay. Next topic. Ready?
Ready.
This one came to me from a user, and just maybe a follower somewhere, maybe on LinkedIn. Question was, would you rather be right on direction or timing?
Ooh.
My personal feeling is direction, I think, because with direction, I guess maybe I got to qualify, because direction, I'm assuming you're asking which way is this going. I know right now. If I know right now direction, timing doesn't matter. First of all,
right.
If all of a sudden I become a premium buyer, not a premium seller. I mean, all things being equal, and let's put implied volatility quotes around it. Am I buying 1 million volatility or something like that? Okay, I get that part of it. Let's pretend that I'm not going to hold this position for any more than an hour, 2 hours, 3 hours, 4 hours, whatever it is. Theta is not going to matter to me because I'm going to make it up in direction. Now, theta might take some of my direction out of it because of it's marinating, but I think I'd rather be right on direction and in the short term, because I'm going to be only a buyer of calls and puts if I know my direction.
Yeah. So here's my question to that question.
Okay.
Is, can you be right on timing without being right on direction? Like if you're saying like a move will happen or a move won't happen within the next week or something like that.
Yep.
But you don't know direction, then you're stuck to straddles and buying and selling.
You're stuck to more gamma plays, let's call it, because you don't know the direction, and you're gonna put on a position that's gonna benefit from either direction. So that's kind of a gamma play, right?
Yeah, and so I think, and the other thing too is because gamma, we as traders, not market makers, we profit on gamma. So for me, and that's like the quickest and easiest way, I would rather be right on direction and take advantage of gamma, like you said, be long gamma on the direction and just be smart enough to get out when I have profit.
Yeah. I mean, think about it. So the direction part of retail trading is so important. However, it is so difficult to wrap your head around and wrap a good strategy around, right? Once someone tells me how to get direction right, the majority of the time, it's going to be unbelievable, because look at there's a toolbox of trades you can make to take advantage of direction. Do you want to cap your P&L by doing a spread? Maybe. Okay. Do you want to not cap your P&L? You're going to go long an option? Okay, great. Is that going to be an outsized move? Where the selling premium part, selling call spreads, selling put spreads comes in, it has a little directional bias perhaps, but also has a non-directional bias if you're doing both sides, the call and the put, and making a condor out of it, right? A short condor. So, there's all kinds of environments where a handful of trades are useful to a retail person. I think that there's only a handful that are worthwhile considering, right? Think about a butterfly, for instance. I love I did butterflies in my trading days. I didn't do them as a butterfly. No one came in and said, Lex, what's your market on this butterfly? No one ever said that, right? They bought calls for me. They bought puts for me. Someone sold me some out of the money puts. Someone sold me some out of the money calls. Before you know it, I had a funky butterfly that wasn't 1 to 2 but to 1. It was just weird. It was 900 by 2200 by 17. It was just goofy. But I knew what all my Greeks were. I was collecting theta. I know where my gamma problems were, et cetera, et cetera.
Yeah.
So the only reason I say that is for a market maker, he's always shifting the ball with his positions by hedging, right? Always shifting. Whereas a retail person, he's looking for a price adjustment of some kind where he sells something at $2, looking to buy it back at $1, okay? And take advantage that way. Can volatility affect it? Yes. Can gamma affect it? Yes. But you know what? You can be wrong on direction and right on the trade, right? Assuming that it's a drifter if you're selling. Yeah. So I'm coming to the realization on the retail side that I like two trades. single long options for my movements and short or long call or put spreads.
So wait a minute, you go naked.
Yeah, I do. I go naked all right. You should see me out on that beach naked.
I do not want that, but
but guess what? That option is not living for me for longer than 2 days. And
something like that.
Right, I'm out of it. I am out of it. So I'm like, I can sell a $5 call spread for 70 cents. I can make 70 cents, or I can lose $4.30, or I can buy a 70-cent call and lose the same 70 cents or lose 70 cents, but I can make infinity. I can make some outsized number. I'd rather play the game if I have a directional thesis. I want to make sure I qualify that. If I have a directional thesis and it's a larger directional thesis, I want to own options. I mean, again, I always put the caveat, assuming implied volatility is in the right stratosphere and all that kind of good stuff.
Yeah.
So I find that I've written these scripts that are now giving me a little bit of an advantage in the directional mode and to the degree of what the direction can be. And when the trigger goes off and the light goes on, I'm not looking for a call spread or put spread. I'm looking for a long put or a long call, period. I could be wrong. I'm going to take my stop and do all that kind of crazy stuff about exit strategy management. It's all there. But I find that, I might have little bitty losses and I get couple few outsized gains that I'm just knocking out of the park. I don't know.
Yeah.
Just me. Someone say something. I don't know. Tell me I'm done.
Usually what I like to do, and I mean, it also depends on the timing, especially like closer timing, like, within like 5 to 15 DTE, I like to do spreads, but a little bit wider, only because as long as I'm able to sit at the computer, because if I'm correct on the direction, I get better gamma and I can roll it.
Right.
Like if you use the same capital on a spread that you would in a naked option, then you get a lot more gamma for your move. And most of the time, even though you can make infinity, most of the time you're not making infinity. Like you're not getting past that.
No, you're not making it. That's because once you have a big profit, you're like, I want out, get me out. Oh my God, this is awesome.
Right. The only time you make infinity is if, some pre-market announcement like today, like Scott Percent's like, we're going to buy long dated treasuries. So then all of a sudden you have this 30-point gap and you're like, hey, I made infinity. I'm out. Like you're getting out immediately.
Yeah. And I think, kind of in the way I look at it for a retail person is having a balanced book of things too. It doesn't mean you can't have some things where you're short a little premium, some things where you're long a little premium based on some of the theses you might have. That's okay. I just find I get a better risk reward bang for my buck by buying cheap things naked. If I have a thesis, I want to keep qualifying. If I have the thesis of movement, as opposed to just selling a call spread. If I say I think the stock's going down, I'm gonna sell a call spread. I'm like, okay, I know what I can make. I can make 70 cents. Why not buy the 30-cent put, and if it goes to where it is, it's got 30-cent put's going to be $1.30. I'd rather do that.
I'll tell you what I love doing: 0 DTE, 345 calls or puts that are like 10 points out of the money.
Yeah,
and get them for like 30 cents, 40 cents, and like we have a metric on Volin called Delta Decay, which takes all like the Vanna and Charm stuff and makes it into how much notional deltas do dealers have to hedge for at the end of the day. And at 330, you start to see a trend without when you start to see a trend without any like movement in the underlying, then at those last like 5 minutes or something, the MOCs or something like that, you're going to see a big spike, right? Or we could see a big spike.
Yeah. How about
and I'll buy those 30-cent 5 to 10 points out of the money. 30-cent, 40-cent calls. There's no spread on that. And then you just hold it, go mow the lawn, come back and be shocked that you made,
I thought about that too. One of my new ideas is same concept, but doing the at the money butterfly, selling it. It's like pinning a tail on the donkey. You think it's going to stay right at your long strike. You do it right at the long strike is the middle part. And 15 minutes ago, because of this MOC stuff, if it goes outside either way, you're going to make the credit. I think the credit's got to be pretty big at 345. I mean, it's got to be a couple bucks on a $5 spread, right?
No. It isn't. That's why I buy those wings and I don't
Man,
sell that middle.
that's amazing. I'm gonna look at it today. Next time I'll let you know what that butterfly is with 15 minutes to go. I seem to remember
usually, like with 15 minutes to go, you usually
what is it,
get
$1?
No. So like if you're doing a 5-point spread, it's probably like about $1.15 maybe.
Oh, okay. That's what I was thinking, $1, but okay, I was gonna say $1 to $1.50. Weird market. So $1.25 is midpoint.
Yeah, but then you only have a 5-point spread on either side. So you have a 10-point gap, and if it moves, then you're losing like $3.
No, I'm not. I'm talking about doing the short butterfly. I'm selling it. I'm selling the butterfly. I think the other side's pinning the tail.
Okay, now I get it.
Yeah, the likelihood of me closing right at my long strike is very, very slim.
Yeah.
Right. I'm going to be now. I might not get outside my strikes, which would make me the whole amount, but depending on what the price of that butterfly is, I'll look at it today. I think it's probably $1.25 is probably accurate with 15.
Yeah.
If
it's
$2,
butterfly, that makes sense.
I got to tell you, if it's $2, I'm going at it like Banshee style.
But if that's the case, why don't you just buy the 5-point wing like at 30 cents each?
If they're both 30 cents, it makes more sense to do that than to sell something for $1.50 that can go to $3.50. Right?
Yeah,
that definitely makes sense. So I'll look at that today. I'm reporting back to the group next week on this.
All right.
I'm
end of day, big gap strategies.
Yes.
Yes. We'll do that next. We'll have to write it down. I do not want an email saying what topic are we doing. Now we know.
End of the day gap strategy. I love it. All right, we got to go. By the way, good to see you.
All right.
Welcome back. What else? You had announcements? Volin.com. We know that.
Oh, Vol.land, not Volin.com. Vol.land.
Damn dummy.
And we actually just released a white paper not too long ago. It's a little bit empirical, but use AI on it because there are some really valuable nuggets in there.
Awesome. I love it. What else? I'm trying to think. Oh, another announcement. Don't forget to visit our new hub page, still hub.tradier.com. You can take the little quiz. I think it's 5 questions, and it kind of tells you, suggests you what kind of trader you might be. And they name them like Maverick and Architect, and it tells you a little blurb about what you are. And then it kind of curates the content in the hub to what you like. Don't forget to subscribe. It's free. Just need an email. I'm sure there's going to be wonkiness. My dog's going to bark in a second because it's brand new. So kind of fun, really cool. I think you're gonna love it. So don't forget to sign up. The other reason is because Jason and I and Mark are going to be live in a new place coming up. We're working on our new Trader Fest for early next year. So You're going to get all kinds of information on that, and you will get the early bird special if you sign up early. So that's it for me right now. Hub.tradier.com, and as always, send me an email. I love emails. Lex@tradier.com if you have any questions or you want to meet and have some fun talking about things. Love doing it. That's it.
Cool.
You good?
I'm good, man.
Happy trading on Mark's behalf. We'll see you guys later.
Yep. See ya.
Bye.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.